Wall Street spends billions of dollars a year trying to predict what you're going to do next. Not the market, you. Let me sit with that for a moment, because I don't want you to move past it too quickly. The biggest, most powerful, most resourced financial institutions on the planet, firms with buildings that cost more than most countries' annual budgets, with technology so fast it measures execution time in microseconds, with rooms full of PhDs whose entire job is to understand the mechanics of risk, those institutions are not primarily focused on predicting the market. They are primarily focused on predicting you. The retail investor, the small investor, the person sitting at home with a brokerage account and a phone and a genuine desire to build something real. Why? Why would they spend that kind of money, that kind of intellectual firepower, on understanding you specifically? Because your predictability is their profit. Think about what that actually means. When you panic and sell, someone is on the other side of that trade, buying what you're throwing away at a discount. When you get swept up in excitement and buy at the top of a move, someone is on the other side, selling what you're desperate to own at exactly the price that benefits them most. Your fear is a revenue stream. Your greed is an opportunity. Your confusion, your anxiety, your impatience, your need to feel like you're doing something, all of it has been studied, modeled, quantified, and built into strategies that extract value from the moments when your emotions are running the show. This is not a conspiracy. It is not something happening in secret. It is openly discussed in academic literature, in institutional strategy documents, in the language of behavioral finance that has been accumulating evidence for decades. The predictability of retail investor behavior under stress is one of the most well-documented phenomena in all of financial research. They know when you're likely to sell. They know what headlines will trigger you. They know how long you'll hold a losing position before you can't stand it anymore. They know, with statistical confidence, the emotional arc of a small investor from entry to exit. And here is the part that I think is the most important. This is not because you are weak or naive or less intelligent than the people on the other side of your trades. It is because you are human. It is because your brain was built for a world where uncertainty meant physical danger, where the fastest response to a threat was the safest one, where waiting felt like losing. Your nervous system did not evolve for financial markets. Neither did theirs. But they have built systems, rules, mandates, algorithms, risk protocols that remove the human nervous system from the equation as much as possible. You have not yet. So before we talk about how to beat Wall Street, and I genuinely believe that small investors beat Wall Street every single day, and I'm going to show you exactly how and why we need to talk about the one thing they are counting on most, the one assumption their entire model of your behavior rests on. And that assumption is this: that you will never understand yourself well enough to stop being predictable. That is what they're betting on. That the gap between your emotional reactions and your rational intentions will remain wide enough and consistent enough for them to drive a truck through. Every time you sit down to make a financial decision, they are counting on that gap being open. Today, we're going to start closing it. I want you to really sit with something for a moment before we go further, because I think the framing of this topic, small investor versus Wall Street, almost always gets presented in a way that makes you feel small before the conversation even starts. You're shown the scale of the institutions, the speed of the algorithms, the depth of the resources, and the implicit message is, how could you possibly compete with that? And I want to reframe that completely, not to make you feel better in some shallow, motivational poster kind of way, but because the reframe is actually, factually, structurally true. You are not in a competition with Wall Street. You are not playing the same game on an uneven field. You are playing a fundamentally different game, one with different rules, different advantages, different winning conditions, and the tragedy is that almost no one ever tells you that. So you spend years trying to compete on their terms. Faster, more informed, more active, more reactive. And you lose on those terms, not because you're not capable, but because you're competing in the wrong arena. Here is the game Wall Street is actually playing. It is a game of scale. It is a game of capturing fractional advantages across enormous volume and enormous capital. It is a game with constant performance measurement, constant client scrutiny, constant obligation to act, constant pressure to justify every decision in a quarterly report. A fund manager who sits in 30% cash through a volatile quarter, even if cash was objectively the right call, will very likely not have that job at the end of the year. The institutions are not free. For all their resources, for all their speed, for all their infrastructure, they are profoundly unfree. They must act. They must be seen to act. They must generate the appearance of control over an environment that is fundamentally uncontrollable. That is the game they are playing. And here is the game you are actually playing, or the game you could be playing if you understood it. It is a game of optionality. It is a game where your most powerful move is sometimes no move at all. It is a game where you can really wait, weeks or months or longer, for exactly the setup that meets your criteria, and no one can fire you for that patience. No one is measuring your quarterly performance against a benchmark. No one is calling you to ask why you're in cash. You have a freedom that the most powerful institutions on earth do not have. The freedom to do absolutely nothing until the moment is right. And in financial markets, that freedom, wielded with clear thinking and psychological stability, is worth more than almost any informational advantage money can buy. That is what I want to explore with you today. That is the heart of what I mean when I say small investors beat Wall Street every day. Not by being faster, not by being smarter in the conventional sense, but by being freer, by being stiller, by understanding themselves well enough to not be predictable, by playing the game they're actually in rather than the game they've been told they're in. Let me give you two pictures, two images that I want to live in your mind, because I find that the deepest truths land differently when they wear a specific shape, when they're not just an idea, but something you can see. The first image is this. Picture two vessels on the same stretch of ocean. The first is a speedboat. It is fast and powerful and loaded with navigation technology. It has a crew, it has a schedule, it has people waiting for it at the destination. It has obligations. And it is impressive, genuinely impressive to watch it move. The second vessel is a small fishing boat, slower, simpler, captained by one person who has been working these particular waters for years. Not with the same technology, but with a different kind of knowledge. A felt, embodied, patient knowledge. Now a storm system moves in. Not a catastrophic storm, the kind that wipes everything out, but a meaningful disruption. Choppy water, poor visibility, the kind of conditions that require a decision. The speedboat responds immediately. It has to. Its identity is its speed. Its clients are waiting. Its crew is watching. It turns hard into the new heading, burns fuel repositioning, throws a massive wake in the process, and in the chaos of the turn, takes on water and discomfort that it wouldn't have encountered if it had simply waited. It ends up 6 miles off its intended course, behind schedule, having expended enormous energy on a reaction that, in hindsight, wasn't necessary. The storm passed in 90 minutes. The fishing vessel captain looked at the same sky, checked the depth, checked the provisions, looked at the calendar, and then did something the speedboat was institutionally incapable of doing. Sat still, dropped anchor, made coffee, waited. And when the weather cleared, the fishing vessel was exactly where it needed to be. With fuel reserves intact, captain rested, ready for the next opportunity. I want you to understand that I am not romanticizing simplicity here. I am not saying small is always beautiful or that big institutions are bad. I am saying something precise, that in financial markets, the ability to wait, real waiting, not anxious waiting, not white-knuckling it through inaction, but genuinely peaceful, strategic, chosen stillness is a structural advantage. And it is an advantage available only to those with the freedom to exercise it. The speedboat cannot anchor and wait. You can. The question is not whether you have this advantage. You do. The question is whether your psychology will let you use it. Whether the silence of having no position, the discomfort of watching movement without participating, the uncertainty of not knowing exactly when your moment will come, whether those feelings are manageable enough that you can stay anchored while the storm passes. That is the work, that is the whole work, in a sense. Now let me give you the second picture, and this one is more personal. I want you to imagine receiving a letter. It's addressed to you in your own handwriting, which is immediately strange, and you open it and begin to read. And the letter starts like this. It says, "I know what you're feeling right now. I know the market has felt like it's moving against you personally, like it's designed to find your specific fears and poke them. Like every time you make a decision, something shifts in exactly the wrong direction at exactly the wrong moment. I know that feeling. I lived inside it for a long time, but I want to tell you what actually changed. Not the system, I kept most of the same approach. Not the strategy, I still use almost the same framework you're using now. What changed was something internal, something quieter than a system. I stopped needing each trade to resolve something in me. I stopped going to the market with questions that the market was never going to answer. Questions like, am I good enough? Am I smart enough? Do I have what it takes? I stopped asking price movement to validate my intelligence or repair my confidence after a bad week. And when that stopped, when I finally genuinely stopped using the market as a mirror for my self-worth, the results began to come. Not because the market got kinder, because I stopped interfering with my own edge. I stopped being in my own way. That letter is from the version of you 3 years from now, after the work. And the reason I share it is not to make the work sound easy. It isn't easy, but to make it sound possible. Because it is possible. And more importantly, it is the actual path, not a different system, not a secret shortcut. So let's talk about what that path actually looks like in practice. Let's talk about the principles underneath the picture, because I want you to be able to take something concrete from this, something that actually lives in your life after this video ends. The first thing I want you to really understand, and I mean really understand, not just nod along with, is that your advantage as a small investor is not despite your size. It is because of your size. And the specific advantage I'm pointing at is this: optionality. The freedom to act or not act on your own timeline without accountability to anyone but yourself and your own clearly defined criteria. I said this earlier in a different way, but I want to go deeper with it now. Wall Street's greatest structural constraint is one that almost no financial journalist or market commentator ever discusses because it's so fundamental it gets treated as just the nature of things. And that constraint is this: they must act. Not because they always want to, not because the opportunity is always there, but because the institutional machinery requires visible, justifiable, documented activity. A portfolio that sits in cash is a portfolio that gets questioned. A fund manager who passes on 10 opportunities while waiting for an exceptional one is a fund manager who has a very uncomfortable conversation with the board about their decision-making process. The system rewards movement. It rewards the appearance of control. It punishes patience in ways that have nothing to do with actual returns and everything to do with the social and political dynamics of managing other people's money. You have none of that pressure. None of it. When you decide to sit in cash for 3 months because nothing meets your criteria, no one calls you. No one questions your judgment. No one compares your inaction to a benchmark. Your job is not to appear to be managing risk, it is to actually manage risk. And sometimes actual risk management looks like doing nothing, like waiting, like being the fishing vessel captain who sees the storm coming and calmly drops anchor rather than burning fuel in a panicked repositioning. But here is what I've observed over many years of thinking about this. Most small investors don't use this advantage, not because they don't intellectually understand it, but because the psychological cost of inaction feels too high. Because sitting in cash while the market moves, even if it's moving in a direction that doesn't meet their criteria, feels like missing out, feels like falling behind, feels like everyone else is doing something and they're doing nothing. And that feeling, that very specific and very powerful anxiety, is exactly what the institutions are counting on. They know that you will find inaction more uncomfortable than action. They know that the pull to participate, to be in, to be doing something, to be competing, is strong enough to override your better judgment more often than not. And so the first edge you can build is the one that costs no money, requires no special access, and depends entirely on your relationship with your own discomfort. It's the edge of learning to sit still, of getting genuinely comfortable with the experience of watching the market move without feeling that you must respond, of understanding that not all movement is opportunity, of being able to say, with real conviction and real peace, this is not my setup and I will wait. And then actually waiting. Now, let's talk about something I believe is the deepest and most underappreciated source of losses for retail investors. Not a lack of strategy, not insufficient research, not even bad timing. The deepest source of losses is this: using the market to answer a question the market was never designed to answer. And that question, in various forms, is some version of, am I enough? Am I smart enough? Am I making good decisions? Am I the kind of person who can do this? Do I have what it takes? Every time you sit down to make a trade or an investment decision, there's a surface level question. Should I buy this? Should I sell this? Is this the right moment? And underneath that question, quieter but more powerful, there is often another question. And that deeper question is about identity, about worth, about whether the outcome of this decision is going to confirm or deny something you need to believe about yourself. When trading is happening at that deeper level, when the real stakes are emotional and psychological rather than financial, everything changes. The way you manage winners, the way you respond to losers, the duration you can hold a position before the psychological pressure becomes unbearable. When a trade becomes a verdict on your intelligence, you cannot manage it for probability. You will manage it for your ego. You will exit winners early because locking in a profit feels like proof that you were right. You will hold losers long past any rational exit point because closing the position makes the loss real, and a real loss feels like a real judgment. You will increase position size when you're on a winning streak because the winning streak feels like evidence of skill, and reducing size would feel like not trusting yourself. And you will freeze or overtrade when you're on a losing streak because the losing streak feels like evidence of inadequacy, and every decision from that place is distorted by the need to either prove yourself or protect yourself from further humiliation. The market does not know you. It is not judging you. It has absolutely no opinion about whether you are intelligent or deserving or capable. It is a mechanism that aggregates information and expresses probability across time. That is all it is. But when you bring your identity into it, when you make it the place where your self-worth gets tested, it becomes something much more personal and much more painful than any mechanism has a right to be. The traders and investors I have found most consistently successful over time, not the flashiest, not the most dramatic, but the most genuinely and durably successful, share something that is harder to see than a good strategy. They have separated their sense of self from their trade outcomes. Not perfectly, not completely, not in some Zen master way where nothing touches them, but substantively, they can take a loss and feel the sting of it without letting that sting rewrite the story of who they are. They can sit in a winning trade without needing to close it early just to crystallize the feeling of being right. They can evaluate their performance honestly because they're not defending their identity in the process. And here is the thing that makes this especially worth paying attention to. This quality, this separation between self-worth and trade outcomes is not a personality trait you either have or don't have. It is a skill. It is something that develops through specific kinds of self-awareness, specific kinds of practice, and a specific willingness to look honestly at the stories you've been telling yourself about what your results mean. Let me add another layer to this, because I think there's a dimension of it that doesn't get talked about enough. And it's the dimension of what happens not when you're losing, but when you're winning. I have worked with and observed a striking number of investors and traders who are genuinely quite good at their craft, who have a real edge, a real system, A real approach that should work over time, but who consistently give back their gains. Who will have a strong month, a strong quarter even, and then somehow find themselves flat or negative by the time the dust settles. And when you look closely at what's happening in those moments of giving back, when you really slow it down and examine the specific decisions, what you find is not bad strategy. What you find is that winning felt more dangerous than losing. I know that sounds strange. I know that if I say it too quickly, you'll dismiss it. But stay with me, because this is one of those things that sounds strange until you look for it in your own experience, and then it's suddenly everywhere. Losing is familiar for most people. Losing confirms the cautious story, the protective story, the story that says, be careful, don't get too big, don't believe too much in what you're building. And that story, as painful as it is at least known territory. It's the terrain your nervous system recognizes. But a real, growing, expanding, undeniable win, that's different. That moves you into unfamiliar, emotional territory. That starts to make things real in a way that losing never does. It raises new questions. What if this keeps working? What if I'm actually capable of this? What if the old story about what I'm allowed to have was wrong? And for many people, those questions are scarier than the familiar pain of losing. So they find ways, unconscious ways, invisible ways, to return to the familiar, to give back the gain, to stay within the boundaries of what they've always believed was possible for them. This is the financial thermostat I spoke about in other contexts. You have an internal set point, a felt sense of what is normal for you financially. And when your results start to move significantly above that set point, your psychology will often work against your strategy to bring the temperature back down to where it feels safe. Not because you're weak, not because you're self-sabotaging in some melodramatic way, but because the nervous system prioritizes the familiar over the better. Because safety and habit feel the same to the part of your brain that's doing the managing. And recognizing this, really seeing it not as a character flaw, but as a mechanism, as a thing that happens in identifiable situations for identifiable reasons, is the beginning of being able to work with it rather than being run by it. Now, here is where Wall Street's predictability model breaks down. Here is the gap in their model of you. They can predict fear, they can predict greed, they can predict impatience and overreaction, and the impulse to move when the right move is stillness. What they cannot predict is a person who has done the internal work. A person who knows their own patterns. A person who has sat with the discomfort of their own psychology long enough and honestly enough to start seeing it before it makes decisions for them. That person stops being predictable. And an unpredictable retail investor, not randomly unpredictable, but strategically, psychologically unpredictable, is an investor who is no longer feeding the machine that was built to harvest their emotional reactions. That is what it means to beat Wall Street. Not to outrun them, not to out-research them, but to step out of the behavioral pattern they've built their advantage around. To be the one person in the room who isn't reacting, who is watching, who has already decided before the session opened what they will do and what they won't do, and who has the psychological stability to stay in that decision when the noise gets loud. Let me also talk about something that I think gets almost no attention in the world of investing advice. And it's the specific edges that small investors have in terms of where they can operate. Because the psychological edge is crucial, it's foundational, but there are also structural and market-based advantages that are genuinely yours and genuinely unavailable to the institutions, and I think they're worth naming. Institutions cannot trade in certain spaces. They cannot buy meaningful positions in small, illiquid companies without their own buying pressure moving the price against them. They cannot exit a large position in a thinly traded stock without the market knowing they're leaving before they're gone. They cannot be patient enough, flexible enough, or small enough to take advantage of the quiet opportunities that exist in the corners of the market that no algorithm is actively monitoring. These are not marginal spaces. These are real, documented, recurring areas of opportunity that exist precisely because the big money cannot fit through the door. You fit through the door, your scale, which you've probably been taught to see as a limitation, is actually an access pass to opportunities that are invisible to the very institutions you've been comparing yourself to. A small investor with clear thinking and psychological stability can move through certain terrain in the market as freely as a person moving through a forest, and an institution is like a bulldozer. It can go fast in open fields, but in the forest, it can't move at all. This doesn't mean all small cap opportunities are good opportunities. It doesn't mean the absence of institutional money is itself a buy signal, but it means that the framework of small investor as disadvantaged player is simply wrong in ways that matter enormously if you're willing to look at the actual structure of where advantages live. So what do you do with all of this? Because I never want to leave you in a world of ideas without also handing you something you can carry into your actual life. Something that works in the real world, tomorrow morning, when the market opens and your phone starts buzzing and the noise starts up again. Here's the first thing. Before you engage with the market on any given day, before you open a chart, before you read a headline, before you make any decision about anything, take a piece of paper or open a notes app and write down, in plain language, your edge. Not in a vague way. Specifically, what is the setup I'm looking for today? What conditions need to be present for me to enter a position? What is my exit if I'm wrong? What is my exit if I'm right? Write it down before the noise starts, before the market is open and moving, and creating that magnetic pull toward reactivity. The reason this works is not mystical, it is mechanical. When you write down your criteria before the session, you are creating an external record of your rational, clear-headed thinking that exists outside your emotional state. And when the market opens and things start happening and you feel that pull to act, to adjust, to respond to something that just appeared on your screen, you can return to that written record. You can ask, does this moment actually meet my criteria, or does it just feel like it does? That distinction between a feeling that something qualifies and an actual qualification is where an enormous number of losses live. The written pre-session definition is how you defend against the feeling. The second thing I want to give you is simpler and stranger, and I think more powerful than it sounds. I want you to start tracking your emotional state alongside your trades. Not in a complicated way, just one extra column in whatever you're already using to track your trades. And in that column, before you close the trade entry, write one word describing how you felt when you entered. Just one word. Calm, anxious, excited, bored, frustrated, confident, uncertain. Just one honest word. Do this for 60 days. Then look at the data. Not the trade data alone, the emotional data alongside the trade data. Look at which internal states correlate with your best outcomes. Which ones show up before your worst losses? I promise you with real confidence, because I have watched this happen in many people's experience, that you will find a pattern. A specific, personal, undeniable pattern. And once you can see that pattern in your own handwriting, in your own data, it stops being a theory. It becomes actionable information. You can start to know, before you act, when your state is likely to produce a good decision and when it isn't. And that knowledge is worth more than any indicator I've ever seen on a chart. The third thing is the hardest, and it's this. I want you to practice doing nothing, specifically and deliberately. Once a week, identify a moment when you feel the impulse to act, to trade, to adjust a position, to respond to some market movement, and consciously, deliberately choose not to. Not because doing something would necessarily be wrong, but because you are building a muscle, the muscle of tolerating the gap between impulse and action, the muscle of sitting with uncertainty without being controlled by it. What you'll notice when you do this, when you let the impulse pass and watch what happens next, is that most of the time, nothing catastrophic occurs. The moment passes. The market moves on. The opportunity you were afraid of missing either materializes in a way that you can still participate in, or it turns out it wasn't the opportunity you thought it was. And each time you observe this, your nervous system gets a small but real update. Inaction is survivable. Patience is safe. The world does not end when you don't immediately respond to an impulse. And over time, those small updates accumulate into something meaningful. They accumulate into the kind of psychological stability that lets you hold a winning trade longer than your anxiety wants you to. That lets you pass on the mediocre setup without feeling like you're missing something important. That lets you be the fishing vessel captain, making coffee while the storm passes, knowing exactly where you'll be when the weather clears. We've covered a lot of ground together today. Let me bring it back to where we started. Wall Street spends billions of dollars a year predicting your behavior. They study your fear, they model your greed, they have built sophisticated, expensive, continuously refined systems around the assumption that you will remain emotionally predictable, that the gap between your intentions and your actions will stay wide enough for them to operate in. And what we've explored together is the path to closing that gap, not through willpower, not through more information, not through trying to be faster or smarter in their terms, but through understanding yourself, through knowing your patterns, through building the psychological architecture that lets you use the advantages that are genuinely, structurally, completely yours, advantages of freedom, of optionality, of patience, of access to spaces where the big money simply cannot go. The small investor who beats Wall Street every day is not doing something magical. They're not accessing secret information or running a genius algorithm. They are simply playing the right game. Their game. The game where their size is an asset, their freedom is a weapon, and their inner clarity is worth more than any terminal or research subscription on the market. You are not too small to win. I need you to hear that. You are the right size to win in ways they cannot follow, not despite your limitations. Because of your freedoms, the speedboat is fast and impressive, and it has an enormous crew. But it cannot drop anchor. It cannot wait. It cannot sit still in a storm and make coffee. You can. You don't need to be faster. You need to be clearer. You don't need more information. You need more self-knowledge. You don't need to compete in their arena. You need to find your own and then operate in it with consistency and patience and the kind of quiet confidence that comes from truly understanding what game you're playing. You're not behind. You've just been playing someone else's game. That ends now. If something in what I've shared today landed for you, if one idea felt less like new information and more like recognition, like something you already knew but needed to hear said clearly, I'd genuinely like to know what it was. Leave it in the comments. Tell me the moment, the idea, the image that stuck. Not for my benefit, though I'll be honest, it helps me understand what to go deeper on in future videos. But for yours, because the act of putting it in words, of naming the thing that shifted, is itself a form of making it real. It's a way of carrying it forward out of this video and into your actual decision making. If this felt worth your time, a like takes 2 seconds, and it genuinely helps this reach the people who need it most. Not traders looking for a tip, people looking for a framework, people who are ready to play the right game. And if you want to keep building the inner game alongside the outer one, the psychological foundation that makes any strategy actually work, subscribe. Because that's what I'm building here. One conversation at a time. The market will be there tomorrow. So will you. Let's make sure you show up as the version of yourself that's ready for it.